I have been tracking the weekly dividend ETFs for a very long time, and I'm still extremely excited when new ones come out. So, we have some great news. Quantify Funds will be releasing some weekly dividends coming soon. I had David Dziekanski on the channel to talk about these and their most popular fund that has never been done before. It's a leveraged exposure to gold and Bitcoin all wrapped into one fund. We talk leverage, future dividends, and BTGD in this phenomenal interview. So, I hope you guys do enjoy. David from Quantify Funds. First question, I want to give some information to the viewers. So if you could give a little bit on your background and history and how Quantify Funds started, and as well as the goal behind the creation of this company.
Absolutely. Thank you so much for having us on your show. I've been in the ETF industry for about 20 years now. I spent the first kind of third of that on the allocator side. We managed about a $2 billion book of ETF assets for upwards of 6,000 financial advisors in the RIA space. And I left and I was the fourth partner and portfolio manager at Title Financial Group. So I spent over a decade helping other ETF companies create, construct, and build their own ETFs, always with the vision of eventually jumping off and partnering with Title as my trust platform to launch Quantify Funds. So we've been live now for about 15 months. Stalwart product, our first product is the leveraged Bitcoin and gold ETF, stacked Bitcoin and gold, ticker BTGD. The concept takes return stacking, which is an institutional process of allocating to two different assets as opposed to leveraging the same asset to embed some diversification into the fund. Really, the hardest thing in life and investing is rebalancing, whether it's leveraged or unleveraged. You kind of fall in love with your winners and you hate your losers. And, if you really have a long-term thesis, you should be doing the exact opposite, which is
hmm
trimming the things that have done best and buying the things that have done worst, unless you have a different thesis on the overall asset class. So this is just a process to embed some of those difficult trades within an ETF for you, which makes the ETF much better for a buy and hold investor looking for a little bit of leverage versus a traditional leverage ETF. There's nothing wrong with traditional leverage ETFs. They just need to be managed to a greater frequency to get your intended long-term leverage target on that investment sleeve. Whereas this allows a lot of that difficult trading to be done within the portfolio, in this case, with Bitcoin and gold in BTGD.
Excellent. So with BTGD, so the goal too with that is if we see kind of in the environment we're in now where Bitcoin's having a little bit of a pullback, gold continues to move upward. So would the fund itself would reallocate that and invest more into Bitcoin at a lower point and less in gold that it's near all-time highs? Could you touch on that a little
Yeah.
bit and kind of the idea behind it?
No, that's precisely it. So it's an actively managed fund, but we'll rebalance generally on a 3 to 5% drift. So when you're seeing these small movements between Bitcoin and gold, we use that as an opportunity to harvest some of the volatility between the two. So as you've alluded to, like in this Bitcoin drawdown, we're systematically trimming a little gold and buying a little bit of Bitcoin. And again, that's alluded to the first, question, the difficulty of doing those trades on your own. Everyone's trying to time the market. We're not trying to time the market here. We're going to rebalance back to that 100 and 100% target between the two. But a real dedicated trading system should have a way to have a little bit of a buy with each leg down on an asset. And again, we find that end allocators don't do that as often as they would like, even though they see the value in it because it's so difficult. And even if they are going to buy low, they're oftentimes going to wait and try to time it and buy a huge chunk at a very low value. And that's great. And that's a really good game to play if you can. But we wanted to construct as a firm these leverage vehicles that can embed a little bit of leverage in your portfolio, but do it in a way where you don't need to always have to trade around your vehicles and you can be more of an allocator to your assets.
Amazing. Amazing. And what was the thought process behind specifically choosing for this fund Bitcoin and gold?
Gosh, I think one of the only certainties in life is that they will print more, right? They being all governments around the globe. We saw the response to COVID was just the most monumental amount of government printing and easing we've seen in the history of mankind. 40% of all dollars in circulation in the U.S.'s history has been printed since 2020, and that doesn't seem to be slowing down. We are running record deficits at a time when our economy is at its highest. GDP is still pretty high. Unemployment is definitely faltering a little bit, but the Fed is fighting a game that they don't have tools to fight right now. The Fed was designed to fight corporate and banking greed, and now it's being asked to curb government overspending and greed and printing. And it, quite frankly, just doesn't have the tool set to do that. So we think one of the most certain things to occur over the next 5, 10, 15, 20 years is all central banks around the world will continue to print. That's like one of the most certain things
Hmm.
I think you can point to in the near future. We tried to change that in the US. There was a big push with the Doge task force to try to curb a lot of our spending. And, it did a little bit. There's talks of it still doing some things behind the scenes right now, but nothing major that's going to structurally change the fact that we spend so much on interest payments, social security, and defense. And that alone right there is so monumental that the
Hmm.
likelihood of that changing any time in our history as participants in the economy is getting lower and lower by the day. Our best hope is that we grow our way out of this massive debt we have with productivity and AI growth, which there's some amazing things happening on that side, but that still doesn't break the equation that for that to work, even that's still going to continue an infinite amount of printing from where we are here today. So I always have had an eye on scarcity assets, whether it was land or Bitcoin or gold, trying to find things that they can't actually physically print. And I think now more than ever, you're seeing the divergence between Bitcoin and the rest of the cryptocurrency space in terms of one is a stored value and one is a technology layer platform. And
Hmm.
there's value to both in your portfolio. But in the concept of a store value trade, which what we were trying to do here with this first product with BTGD, the two purest, most liquid stores of value in this world, in our opinion, are Bitcoin and gold.
That's really interesting. I wasn't always a fan of crypto. I mean, I didn't dislike it, but I didn't trade it as actively as I did the stock market. And then everything changed. I was on vacation and I saw a commercial by Coinbase. And it was really interesting because one, their marketing team was phenomenal, but all they did was showcase in a really well done video the if you had invested like $10,000 into Bitcoin versus into just holding it in cash, and over time how much more cash you have to counteract the loss of the inflation. And it honestly changed my entire outlook. I was standing there watching. I was like, that's when it clicked. Like it makes perfect sense now that it's something that's anti-regulatory in a way. They can't just create more and more and more. So that scarcity does really make a big difference. So that's
And
amazing.
that's
And why gold? Oh yeah, go ahead.
and that scarcity is different again from the rest of the crypto space, which we think there's a lot of value in. And in Bitcoin, one chart that we're going to start circulating soon is looking at the Q's return
Hmm.
in dollars, the Q's return in either Bitcoin or the Q's return in gold. So I think everyone knows, obviously, since 2020, Bitcoin has outperformed the Q's, right? If you did a return that was long the Q's and short Bitcoin, you would have lost money over time. But I think what people are less understanding of is that that's also true for gold. So if you had owned the Qs and shorted gold, you would now be down money since the start of COVID, which I don't think people truly realize how fast their purchasing power and store value is eroding over time. And even just a little bit of an allocation into Bitcoin and gold in your portfolio, I think is very warranted. And it's still really, really early, right? You see very few institutions with high levels of Bitcoin allocations. You're starting to see the RAs turn as we speak, whether it's Morgan Stanley about 2 or 3 months ago, Schwab just recommended an allocation. Bank of America just recommended an up to 4% allocation to your entire cryptocurrency basket. France is talking about trying to make Bitcoin 2% of their strategic asset base try to own 2% of all outstanding Bitcoin as a goal for their reserve. And you're just seeing more and more central banks move away from dollar-based and bond-based assets as their reserve holdings and moving closer and closer towards true scarcity assets like Bitcoin and gold. What does scarcity mean? It's literally just think of it as mining rates. What is the supply of these assets? So as of right now, since the halving last year, Bitcoin mines at about 0.86% a year, so under 1% new supply. When Bitcoin had 15% supply 10 years ago, it's a very different story, right? You had to like Bitcoin and convince your neighbor to like Bitcoin because all this new Bitcoin was coming to the market. There's very little new Bitcoin coming to the market right now. And that's the same truth for gold. Gold mines at about 1.75%. So it's just an equation of how fast you think they're going to print paper currencies. And
Hmm.
this unique stack and the uniqueness of these two assets is that even though they have this amazing characteristic of store value between the two of them, they actually trade very independent of each other. And so that's allowed us to launch, BTGD. We launched October 15th last year. We've had less downside than IBIT, meaning when IBIT is down on average, we're down less, and more upside than IBIT. Because when things get very volatile on Bitcoin, more times than not, gold tends to store and hold its value. So we end up being this 200% total exposure ETF that when our most volatile asset on the downside is going down, gold does not show a lot of volatility during that period. In some instances, is even up. So we have a very good paper on our website called "The Case for Bitcoin and Gold" that reviews and shows some fun charts on that as well.
Amazing. I'll give the link to the website down below for viewers to go check it out and check out that paper. Very interesting. So, who would you say is the ideal investor when it comes to quantify funds?
Yeah, I mean, I think if you have an equity portfolio that's only like 30 or 40% of your allocation, you quite frankly probably don't need us. That's including all options equity vehicles as well. So if you're a super conservative investor, you don't need to use any leverage in your portfolio. You can just candidly buy individual Bitcoin and gold ETFs. But it's really that allocator that has 60, 70, 80, 90% equities in their portfolios. Every institution in the world uses some amount of leverage, mainly for diversification. You won't find many of them structurally over 100% in equities, but to go further and provide diversification to your beta in the equity markets is a very sound way to do portfolio construction versus, pretty much any other
Of course.
approach of trying to time the market. Whether, I think people shy away from leverage because they hear of these horror stories of like, being 200% totally in the S&P, 300% in the S&P, et cetera. And that's one thing. But if you are adding Bitcoin, gold, even treasury bonds, or some alternative strategies on top of your broad equity exposure, that could be very additive to your overall returns and not really add a whole lot of risk. As we showed before, like the actual volatility on BTGD is just a tad bit higher than IBIT on its own. And most of that added volatility is coming on the upside, right? So not all leverage is constructed equally. You have to think about how it'll perform in different markets as BTGD is designed. And then secondly, you also have to think about the expense of that leverage. Like what is the actual cost embedded in the ETF to get that leverage? Swaps get a bad name. Sometimes swaps on certain assets can be priced well, but oftentimes swaps can be very, very expensive forms of leverage. And there are also forms of leverage that over time can get a lot more expensive in moments of volatility because the bank could just say, "Hey, we don't feel as comfortable about this position. We'll either close it down or charge you more." Right. And that's when oftentimes a lot of ETFs get in trouble that are using very eclectic swaps because they get very, very expensive at the worst times. Right. Guess what? During tariffs, when the volatility is spiking, the market's pulling back, swap prices go up. So we're getting
Mhm.
our leverage through futures right now, and also soon to be also a portion from synthetic options. This is a very cost-effective form of leverage. The cost of leverage in the futures markets you can think of as essentially the T-bill rate. And so if you're trying to figure out, well, what should I expect return-wise from BTGD? Most simply, if you take the return of Bitcoin plus the return of gold, you minus the cost of financing, it'll vary a little bit from that from trading, et cetera, but it'll be pretty close to those two returns over a long period of time. And so the beauty of this too is if you're that growth investor and you have some stocks and you have some Bitcoin and you're like, yeah, I know gold could be pretty good, but like it doesn't have enough juice, right? The beauty of return stacking is it's like additive without being subtractive. So you
Mhm.
can add gold to your portfolio without having to subtract like serious beta drivers in your portfolio, like equities or Bitcoin. And so in that essence, gold doesn't have to outperform the S&P. It doesn't have to outperform Bitcoin to be additive to you. It just has to outperform the cost of financing. And so if you think about it like that, it's again a way for an allocator to build a structural portfolio with a little bit of leverage at very cheap rates. When I say T-bill rates, right now we're talking like low fours,
Hmm.
lower than most people can get on their own. You don't have to deal with margin and margin calls. Our count isn't actually on margin or will be margin called. So that's the beauty of getting it through futures and a little bit in the option space as well. So it's a leverage ETF that you don't need to worry about, irregardless of what's going on in the market. You don't need to all of a sudden run to it and be like, oh my gosh, I have to start trading this because XYZ happened. So it's a structural way to get out leverage in your overall portfolio. And honestly, it's oftentimes easier to try to outperform an equity benchmark by structurally diversifying around it than it is to be a stock picker within it. And there's some fantastic stock pickers out there. But this is, we think, a little bit of like a less hectic way to try to get a little bit of alpha in your portfolio.
Very interesting. I used to be I guess I would say afraid of leverage. I didn't really consider it much, and then I started reassessing my views on what the market's going to do, how it's going to work, in the long run. Not talking 6 months, but 6 years, a decade and whatnot. And so then I started getting more comfortable with the idea of leverage. But I want to know what do you say to someone who says, "Oh, I don't want leverage. It's too risky." Because I get comments about that whenever I mention any sort of leveraged fund, whether it be a 2x, a 1.2x, even people are just seem to get scared, I would say, or just are more risk averse to that style of utilizing leverage. But what are some of the main pros in your opinion?
I think leverage isn't for everyone for sure. But I think people often times have a lot more risk in their portfolio than they realize. So you might have a 100% equity portfolio, but if 50% of your allocations are in really small cap growth names, et cetera, you can make a lot of high highs, but you can also have a lot of big drawdown. And oftentimes, even if it's a leverage vehicle, you might be bringing down your overall portfolio's risk if you're trimming a little bit of your super risky equity portfolio or equity ETF portfolio and allocating something that has a better chance of diversifying those big swings in your portfolio. Bitcoin is pretty correlated to stock markets. So I think one of the beauty of what we're seeing as of late that's not being talked about enough is like, yes, right now we're in a period where stocks are going up and Bitcoin's kind of trending sideways. Since when has a drop in correlation between stocks and Bitcoin been a bad thing, right? Everyone is so eager for these high prices to come like right now. The beauty of markets is you can't time the short term. Supply and demand always drive the long term. That's a Warren Buffett concept. That's nothing new into the marketplace. And so I always think like these are opportunities to rebalance, right? Are you rebalancing back to a Bitcoin target that you had because it's drawn down? So I think now is the time to reconsider. Like I always look at each asset class. How's that asset class performed versus its highs and lows over the last 5 years? Stocks are near an all-time high. Bitcoin's probably at its 75th percentile. Treasuries are probably at its like 55th percentile, somewhere like that. So you have to look at like trying to buy things at discount, not relative to just a historic price, but just to every other asset that you have an opportunity to invest in. I think looking at things versus historic dollar level prices is a little bit irrational, especially at a time where, you know, people think and the actual inflation that you feel as a consumer is so much higher than what you see on these prints. Your dollar is eroding and losing value. And so just looking at like, oh, this price here versus that price there, like that's not the way to invest. You have to look at everything relative to your other investment opportunity options.
Very interesting. That's a really good explanation to that. And that kind of feeds into our next segment, this next question that we did touch on it a little bit, the combining of two underlying assets. But what I want to kind of layer on top of that is what is the reasoning behind making the selections that you guys have done when it comes to these ETFs? And for the viewers, we actually should, if you could give a few examples of the underlyings and the ETFs overall, in case they aren't familiar with them.
Yeah. So our first product is the stacked 100% Bitcoin and 100% gold ETF, ticker BTGD. We have a similar stack on NVIDIA and AMD called Lays, as well as in the crypto space with MicroStrategy and Coinbase. The concept with the Bitcoin and gold one was to do a store value long term allocators toolset investment. Stack stocks are more on the trading tool side for sure. And we think it's really important for ETF issuers to say, like, what are the risks of their underlying ETFs? There's less correlation benefits between AMD and NVIDIA than there is between Bitcoin and gold. So you will have the onus of rebalancing it a lot more. But, obviously AMD and NVIDIA have been two of the best performing semiconductor companies in the entire world. So that performance has been exceptionally strong. I would say we're moving further into these leveraged allocator ETFs with a lineup that we're launching in December, right after Christmas, right before the New Year's. So we'll be taking that same concept of stacking or return stacking and doing so in the derivative income space as well. So we'll have a stocks and Bitcoin pair. We'll have a Bitcoin and gold pair, and then we'll also have an ETF that is what we think is kind of the closest thing that we'll launch so far to a true hedge fund in an ETF, where we'll pair Bitcoin with crypto treasury companies and go long or short different crypto treasury companies such as MicroStrategy or Mara or Riot or any of the other ones out there, and try to take advantage of either expensive or cheap MNAVs, and still generate a really, really hefty, decent rate of return and yield on the overall product. So all those will come out right at the right around the end of the year, right before New Year's, and we're really excited for all of those. We also have a 2x basket of crypto ETFs coming out that looks beyond Bitcoin. We think Bitcoin is the store value asset in the crypto space, but QXAS will be an adjusted market cap weighted 2x basket of Ethereum, Solana, Cardano, and Ripple. So you get to basically just trade the rest of the crypto ecosystem as a index basket. And again, the idea there is providing that is, either allocators tools like, BTGD and the stacked income, or trading tools like the 2x basket of crypto beyond Bitcoin and, the stock pairs. And, I think there's going to be a time where you're going to want to own crypto beyond Bitcoin. It's obviously been a frustrating trade as of now. We can have a whole conversation later on as to where we think the validity is in the rest of the crypto space. It's in the technology and the things that get built on it, and stable coins being built on it, JP Morgan having their own stable coin. These things give real true validity to the technology that is blockchain. But gosh, the hardest thing in the world to do is try to pick the one. And so we want to move people away from trying to pick the one to saying, worry about crypto beta before you worry about crypto alpha. We're big believers that the majority of your crypto allocation should be in Bitcoin. But then once you're going beyond Bitcoin, how you do that, we find, is really difficult for individuals. And they end up just picking a couple of random coins that they don't really know a lot about, when I think what they're really trying to do is just like bet on that ecosystem. So that won't be an income product, but that'll be another like high beta, hopefully something that can really have strong returns over the next like 5 or 10 years. If you listen to some of the people out there like Tom Lee, et cetera, talking about these crazy Ethereum prices and Solana and XRP, et cetera, there will be winners out of those baskets. And so instead of trying to pick that yourself, we'll create a very simple ETF vehicle. You can just invest in a 2x version of all of those.
That's never been done before, has it? At least I'm not familiar. Because I
No.
actually was thinking about that a little while ago, kind of I guess even as like a growth ETF positioned into all these different cryptos. And what's interesting too is people do want access to the sector, to cryptocurrency, but without the hassle of storing the coins, picking and choosing, like you said, trying to choose winners out of, any group. And there's such a deep understanding to these cryptocurrencies and the use cases. And like I said, I'm relatively a novice at this, right? I'm just kind of like a buy and hold, invest every once in a while into the crypto space. But it is really cool seeing this now plugged into brokerage accounts. We can buy them on the markets and utilize the ETF platform for it. But I'll be looking out for that one because that's really interesting. And I think it honestly is a phenomenal idea.
And we're a big believer of, you know, your first allocation to an asset class should be the actual commodity itself. If you want to trade tactically, the crypto trading, mining companies, et cetera, things like that, there's absolutely value in that. But if you look at like gold miners over the last like 34 years, there were many, many painful moments where gold was doing really well and the miners were doing really, really terrible. And people tried to increase their return on an inflation hedge by going to the miners. And that just worked absolutely horribly. And so we always think like if you're when you're starting in a new category like cryptocurrency or precious metals, actually getting exposure to the underlying themselves. Obviously, we'll be doing so through futures and options as well. But getting the actual returns of the underlying, we think are most important. And what most people believe is as like staking actually occurs in the ETFs, that those prices will be reflected directly to the futures prices as well. So sometimes not overthinking it. And again, there's a lot of good management that could be done rotating around amongst a lot of those players too. But just having a very simple tool that just gives you exposure to everything else but Bitcoin. I think a lot of people are comfortable with trading ETFs in their with Bitcoin and have a lot of Bitcoin in ETFs already, but are trying to figure out how to attack the rest of that space. So hoping to provide a kind of one-stop shop solution trading tool for that.
Excellent, excellent. And we touched on income a little bit. Is there a potential income product in the works? Is that something that Quantify Funds would consider?
Yeah, so we have three income-oriented products launching right before New Year's. We're
Excellent.
partnering with a company called Convexitas out of Chicago with a lot of institutional knowledge in the options space. Ed Francis, their head PM there, was with SpiderRock, one of the first portfolio managers at SpiderRock, which is largely considered one of the most respected options hedge fund in the country. I think a lot of people have learned in the option space is that not all option strategies are created equal. And it's not just the philosophy of construction, but also the execution on a trade basis, especially when you're trading so much. Like, how well are you actually executing and trading? All these things are really, really important to your experience as a shareholder in an options based product. So we won't have like these 60, 70, 80% yields that you see. They'll definitely be a little bit more conservative. But the beautiful thing is we are stacking two different, essentially almost option strategies on top of each other. So our first two in that lineup to be launched at the end of this year is going to be a Bitcoin and gold one and a stocks and Bitcoin one. So ISBG and ISSP for income stacked stocks and bonds, income stacked Bitcoin and gold, will come out right before the year ends. And so we will have an attractive overall distribution rate because you can think of it as stacking two different cover call strategies on top of each other. And just like with BTGD, you take advantage of the ability for us to rebalance between those two asset classes, and we don't put that onus on you. So, hey, as an allocator to both stocks and Bitcoin, are you doing the difficult rebalancing between those two assets? No. Well, this is a vehicle that will do that embedded within the ETF for you. So again, the whole concept of our firm is trying to provide tools that can provide hopeful alpha for our shareholders, obviously. And we think some structural leverage with that diversification built in is a way to do it because oftentimes a lot of the value you have in your portfolio is rebalancing between assets. And so offering lineups that are doing this embedded in our process, we hope is a very good way to give shareholders like a very good long-term experience in a product.
I think it's really interesting too what we're seeing in the high yield space because we've kind of seen a pull away, a shift from those 50, 60, 100 plus percent yields or distribution rates where people are really, I think, realizing now that long term, that's it's not simple to get a phenomenal performance. And even if you do have a high yield, high distribution rate, that doesn't mean performance is good. People kind of forget the fact that overall return versus yield is a really important factor to compare. So I always love it when new funds launch that aren't boasting insanely high yield, but still have consistent yields and can kind of maintain that NAV. So for you guys, what was the reasoning behind kind of shifting, or I shouldn't say shifting because you're still going to do the growth funds as well, but to incorporate some income funds?
I think it's something that's really needed for retail right now. I mean, our whole intention and goal is to create a firm that is a hedge fund like offering for obviously advisors as well, but also for individuals for so buy and hold leveraged vehicles that give you a chance at alpha over the long run versus just owning just the S&P 500 by itself. And so to do that, we needed to offer a little bit of structural leverage in this space. And I think the income side of it is like just the state of the economy right now is such that like 90% of people in the economy don't have disposable income. So I think they're very much looking towards managed distribution ETFs as something they can count on to be a part of their income to cover their mortgage payments, their car payments, their credit card bills, their student loans, etc. I think they have real live payments tied to this. So doing it in a vehicle that, especially with a leverage vehicle, will have some movement, but the goal is like in 5 years and 10 years, the actual distributions and payments you get from these vehicles are the same or increasing. And that's really the goal, is a long term, yes, we're going to be a weekly payer, but you want to try to minimize the volatility of like, what am I getting year over year as a payment from this? And I think it doesn't always, it's not just for people like without like, with a shortfall in income. I think if you look at the, middle bracket, 1 to even $10 million investor, it's like, I want something besides the S&P 500, and nothing makes sense in the private markets right now. Real estate or private equity, buying a small business and competing with a private equity firm that has like almost free leverage to make these purchases. It's really hard to have a secondary income stream in this world. And I think a lot of people view this as better than a lot of the alternative investments that they can get out there to generate that second return stream. So we're trying to offer that as like a consistent second return stream to individuals. Over time, we hope the dividend payments pay out. Obviously there will be volatility when you're dealing with things such as stocks and Bitcoin. Even the Bitcoin and gold one has shown some volatility, but over time you want those payments to be stable. And so we're going to continue to launch ETFs in many different categories, but really as a whole, our goal is to offer hedge fund like solutions in an ETF wrapper that you can, either buy and hold, or will mark very clearly as trading vehicles, like the 2x crypto basket. You can hold that for a little bit of time, but like that is a true trading vehicle. It could rip up, rip down, like you'll have to rebalance that. And I think, first and foremost is like just trying to clearly display that message of like what are, allocators trading tools in our lineup, and what are more, the trading vehicles that you do need to watch more cautiously.
Very interesting, very interesting. So looking ahead to 2026, and I know that there's limits on what you can say, how you can answer these questions, not financial advice for everyone watching, but is there a specific industry, asset class, other than what we've discussed, that Quantify Funds is going to be looking at closely for 2026?
Yeah, so I spent 12 years at Title. I have probably 100 ETF ideas on my on my list. What I would say, we're going to continue to try to innovate and offer things that are both of value, unique, and haven't been done before.
Hmm.
Always trying to pioneer what can be done in the ETF space, and provide a unique vehicle that has the at least the chance and opportunity to give you guys alpha, and really trying to build a you know retail focused hedge fund like offering in the ETF space. I think a lot of brands in the ETF space have done very well in asset raise in the last 7 years. And I think sometimes they discredit brand value and the actual experience of being a shareholder in the product. And so first and foremost, we want to offer a lineup that our shareholders have a very good experience in.
Amazing. Amazing. Yeah, that's what it all comes back to. Love that. Love that. Final question is, what is some advice you would give to investors, both new and old, about the volatility that we are seeing in the crypto market, in the stock market currently?
Yeah. If you are allocated to a asset class and it goes down and you do not feel comfortable allocating a little bit more to that asset class, let's say your thesis on it hasn't changed, then you're probably over allocated to that asset class. Right. You should be able to rebalance within your portfolio on all assets, your risky assets, your less risky assets. But if you like something in the long term and your investment thesis doesn't change, you have to look at moments of volatility as an opportunity to increase your allocation to that underlying investment. Most simply, if you're just, obviously we very much like Bitcoin and gold, but let's say you're trying to hit a target of 90% the S&P, 10% Bitcoin, and 10% gold, right? You have to use drawdowns in one of those assets versus the other as an opportunity to rebalance. And like that's the fastest way to add value, is taking advantage of correlations that you have in your portfolio.
Excellent, excellent. Are there any final thoughts that you would like to give to viewers?
No, thank you very much for your time. I love your show, and I'm really looking forward to our new lineups that are launching at the end of the month, and more to come on all of those. So thank you.
Excellent, excellent.